Ever since Russian troops and tanks came screaming across the Ukraine border, the stock market has been going through wild gyrations. Markets had already been down about 10% prior to the invasion as a result of worsening inflation, higher interest rates, and rising oil prices. And there was, of course, the dread of the coming invasion, which pressured stocks to go lower, as nobody likes the uncertainty that could follow such a calamitous event, and perhaps even a threat of world war that could go nuclear. Individual stocks have been through heart-throbbing rides. Meta Platforms Incorporated, better known as Facebook, was down and reeling even before the invasion. In January this year, Facebook was trading in the 330 range, down from its recent high of 378 from just a quarter earlier in the beginning of September. Since a lackluster forecast about future growth and increasing competitive pressures by TikTok and other social media, Facebook has dropped like a rock all the way down to the very low 200s recently. With fresh news just out about Facebook being shut down in Russia due to their shutting out Russian government propaganda, might Facebook see even further weakness? Cigarette maker Philip Morris was riding high at 111 less than a month ago on February 14th pre-invasion. Perhaps because of their exposure to sales in Russia accounting for 12% of global sales, their stock has come tumbling down to just under 100 on March 4th. Will there be further declines in Philip Morris's future? Zacks rates them a 3 hold as of the close on Friday, and despite none of 18 leading analysts rating it a sell, we might see some revisions in the future. Not all stocks have been in decline, of course. Some stocks are sharply higher based upon the very factors that are putting other stocks down. EOG Resources Incorporated, ticker EOG, is a $60 billion plus energy company that has seen its fortunes rise as a result of the war and rising oil prices. EOG Resources was one of the largest oil and gas producers in the U.S., with proven reserves in the U.S., Trinidad, and the United Kingdom. With oil prices heading sharply higher, there could be a significant tailwind driving the company's fortunes and stock prices higher. Argus Research gave them a buy signal with a target price of $123 based on large, key shale areas to support long-term production growth. Trading as low as 62 last August, EOG closed on Friday at 116 and change. And perhaps if oil keeps rising, it would seem reasonable that their stock price will follow. Of course, there is the risk of the unknown in the Russian invasion of Ukraine, but if this continues to be a long, drawn-out conflict, or one where Russia overwhelms Ukraine in a short order, but a low-wage guerrilla conflict persists, the fortunes of these and other companies will continue to rise and fall. What do you think? What comes next? Please leave your comments below and be sure to like, share, and subscribe to Stock Market Fever for future alerts.